Gold miners. Cash is king. Since the start of the year, central banks have purchased over 4 million ounces of gold. April was a big month for central bank activity. Over half the amount of gold purchased in 2021 was in the month of April alone. In April, central banks acquired 2.45 million ounces, worth over $4.3 billion. Gold reserves in central banks continue to appreciate and are at the highest levels since the World Gold Council began keeping track in the year 2000. That's the chart you're looking at right now. But central banks aren't the only ones bolstering their balance sheets these days. Gold producers' balance sheets, the healthiest ever. After a decade of continuously declining cash reserves, gold producers are flush with cash today. In fact, the gold producers have never had more US dollars on their balance sheets than they have today. In fact, over the last 15 months, at the sector level, cash reserves have more than doubled. Today, the cash positions for the North American listed precious metal companies are over 27 billion US dollars. And thanks to strong gold prices, I expect them to climb even higher. That's the chart you're looking at right now. This dramatic boost in cash reserves is primarily due to the current gold price and lack of new large production projects by the industry as a whole. Gold producers kept operating costs in line all through the mid-2010s, when gold prices were depressed. In doing so, they've all now been provided with the opportunity for rapid profit margin expansion. Going back to as far as 2007, the EBITDA margins have never been as high as they were in Q1 of 2021. That's the chart I'm showing you right now. This is the EBITDA, earnings before interest, tax, depreciation, and amortization. A delicate balance of debt and equity optimizes returns to both debt and equity holders. These improving profit margins have led to gold producers reducing debt on their balance sheets. Total debt has declined over 28% from $40 billion in 2014 to $28 billion as of March 2021. That's the chart you're looking at here. So, what's this mean for gold stocks? Strong gold prices mean faster payback of capital for miners. This improves asset valuations and supports higher share prices. Strong profit margins and declining debt profiles set the stage for gold producers to improve shareholder returns through two major ways. Improve alignment with shareholders through increased dividends and buybacks. After a decade of paltry distributions to shareholders, investors will be demanding cash being returned to them instead of the corporate pockets. This is a similar situation to what we've seen in the oil patch over the past 12 months, as companies fight to keep shareholders invested in them, and eventually acquisition targets. Income that's not returned to shareholders should be reinvested in growth opportunities, either organic or through acquisition. Strong gold prices provide support for takeovers and incentive companies to grow through acquisition. Gold merger mania? Is it about to heat up? Transaction volumes in 2021 are off to a very slow start. But given the balance sheets and strong gold prices, more deal volume is likely in the second half of the year and into 2022. That's the chart you're looking at right now. Basically, is what were the transactions per year in US dollars in the M&A, mergers and acquisition. As deal volumes pick up, I believe there will be a premium paid for deposits in positive swapline nations. The reason's twofold. There's less jurisdictional risk in positive swapline nations. No miner wants their mine nationalized, nor do they want to give up 25% for free to the government after they pay a pretty penny for the deposit. As a shareholder, you shouldn't either. Today, I see far more complacency with this than ever before. Yet there's a never-ending barrage of headlines for increased royalties, taxes, and government takes. High-quality deposits are hard to come by. Average grades are dropping and have essentially forced miners into risky and negative swapline nations. This makes those deposits located in safe jurisdictions that much more valuable. So what's the best way to identify which deposits and which companies that'll be at the top of each gold mining major shopping list? You could sift through hundreds of technical documents and spend years traveling to remote areas while completing thousands of hours of due diligence. Or you could take the easy route. As a professional manager focused on the natural resource space, I've dedicated my whole career to this sector. I know all the big players and have one of the best Rolodexes in the game. As an example, a very large position in my own portfolio and one of my subscribers are up over 400% and it's led by the gentleman of mining. And he hasn't even done an institutional presentation yet on the company. You got to get ahead of the curve. Another large position is backing a billionaire and a serially successful resource tycoon, a gentleman who I've known for over a decade and have made millions of dollars with due to success on his previous deals. My subscribers know exactly what prices I'm willing to buy and sell at. At Katusa Research, I'm not just about delivering those winning stock picks to subscribers of my premium research service, but I'm also about educating investors. I freely share my research with my subscribers and always outline my exact due diligence process every time I recommend a new idea. Instead of loading up on the latest meme stocks over at Wall Street Bets for a shot at the moon, consider subscribing to the KRO to learn about my alligator strategy of investing. Stay safe.